Hey folks, this is your accountant Mansoor Sohail. I operate out of Toronto and my specialization is taxes for Canada and USA. This information is for educational purposes only. It does not constitute any legal advice or opinion, so please do not use any of its contents without seeking a professional advice. So, we are talking about foreign income exclusion today. US citizens or residents who meet certain requirements can elect to exclude from US taxation a limited amount of foreign earned income and housing cost amount. Let's compare exclusion and credits. Exclusion completely eliminates the US income tax on the qualifying amount of foreign earned income. Under the foreign tax credit option, the United States collects any residual US tax on foreign source income. The exclusion eliminates the US tax on the qualifying amount of foreign earned income derived by an expatriate working in a high tax jurisdiction. Under the credit option, the expatriate receives a potential added benefit in the form of a foreign tax credit carryover. Foreign taxes in excess of foreign tax credit limitation can be carried back 1 year and carried forward 10 years. Qualified individuals. Who is qualified individual? The one who is physically present in a foreign country for at least 330 full days during any 12 months period or is a bona fide resident of a foreign country for an uninterrupted period that includes an entire taxable year. The individual's tax home is a foreign country. Exclusion amount. The maximum amount of foreign earned income that is eligible for the exclusion is adjusted annually for inflation and is prorated for the number of qualifying days in the taxable year. The maximum exclusion amount is $100,800 for the year 2015. A qualifying day is any day within the period during which the individual meets the foreign tax requirement and either bona fide resident requirement or the 330-day physical presence requirement. Pension income does not qualify for exclusion. Employment-related allowances, such as foreign housing and automobile allowances, also qualify for the exclusion if the allowance represents compensation for services performed abroad during the qualifying period. Any deductions allocable to excluded foreign earned income, such as unreimbursed employee business expenses, are disallowed. Medical expenses, charitable contributions, alimony payments, IRA contributions, real estate taxes, and mortgage interest on a personal resident personal exemptions are deductible in full. Housing cost amount. An expatriate who qualifies for the foreign earned income exclusion can also claim an exclusion for the housing cost amount. Eligible expenses include rent, utilities, real and personal property insurance, certain occupancy taxes, non-refundable security deposits, rental of furniture and accessories, household repairs, and residential parking. Cost of purchasing or making improvements to house, mortgage interest, and real estate taxes related to a house that taxpayer owns, purchase furniture, television subscriptions, or domestic help expenses are not included in housing expenses. Electing exclusions. How do you elect them? Use Form 2555 for making the selection to exclude housing cost amount. Foreign earned income exclusion will remain in effect until revoked. A taxpayer must wait 5 years to reinstate exclusion. Reporting foreign assets. U.S. persons with foreign financial accounts must file Form TDF 90-221 if they have financial interests or signing authority over any financial account in a foreign country and total value of these accounts exceeds $10,000 at any time during the calendar year. FBAR is not an attachment to U.S. income tax return. It is rather filed separately with the Department of Treasury by June 30th of the following year. Folks, all this information comes from the book Practical Guide to U.S. Taxation of International Transactions, ninth edition, written by Robert J. Massey Jr. and Michael S. Shadewald. Publishers are Walter Kluwer, CCH Incorporated.